Hello, I'm Arvind Chari. I'm the Chief Investment Officer at Q India UK, which is an affiliate of Quantum Advisors India, which is a sponsor, of course, of the Quantum Asset Management Company, which runs Quantum Mutual Fund. I'm here to talk to you again about what's happened in the markets. How do we see the recovery, the earnings, the macro scenario panning out? And what should you as investors think and do and invest in these times of what we see going forward? So if you look at the equity markets, India has continued to perform relatively well. Although for the month of July, MSCI India had underperformed the MSCI emerging markets or the MSCI Asia. But if I look at over the last 3, 6 months, 12 months, or even on a YTD basis, the MSCI India has actually outperformed MSCI emerging markets, Asia Pacific, by a reasonably good degree. So that just shows what we've been telling and talking about, the earnings recovery that we are seeing in India, the increase and improvement in private capex activity, private investment activity, which is all fueling in a reasonably large amount of earnings growth, and that's kind of getting reflected in the markets. Of course, if I look in the global markets, if I just look at NASDAQ, India is definitely underperforming. NASDAQ is at some different orbit. I think it's up about more than 35% YTD as of end July. That just shows you the kind of returns that the US tech sector is getting again from the correction that it saw in 2022. But coming back to India, I think we are as we said, we've been over the last 3 to 6 months, as I've spoken to you, we've been positive about what we are seeing at ground level. We were expecting economic activity to be better than what others were predicting. Ground level business related feedback that we were getting was much better, and that is getting reflected in earnings. Although if I look at the broad market, all indices and all markets have done well. But if I break up our market performance from the large caps to mid cap and small cap, of course, the last 2 to 3 months has purely been a mid cap, small cap story. I think they're both up about 20% in the last 3 months, as compared to the Sensex, which has gone up about closer to about 9% in that same period. So almost all of the mid cap, small cap rally seems to have come post that mid March period. What we're seeing right now. And so there is definitely some amount of euphoria. I think there is definitely pockets of significant overvaluation in certain mid cap and small cap, especially in that space. But there is earnings recovery also. So it's not everything is completely expensive. Although on a relative basis, valuations have gone up quite dramatically, both in the large cap space and as well as in the mid cap, small cap. When we look at the way Quantum long-term equity value fund is positioned, and what it from their outlook, it is reasonably invested, but valuations are getting expensive. We are finding more trim names as compared to new names in the portfolio. I think that is what the general consensus seems to be, that valuations have maybe gone ahead of earnings fundamentals. But we should see the recovery happening. So markets may sometimes run ahead of kind of fundamentals, and it will have its own way of correcting. But there is a reasonably good amount of economic recovery that we are seeing. The government continues to keep trying and improving manufacturing in India. The recent example would be the ban on laptops and desktops. Very sudden decision, but of course it's been on the works. They've launched the PLI scheme for incentivizing laptop manufacturing and desktop manufacturing. It hasn't worked. Companies haven't bid, and now they're forcing by kind of completely banning import of those items and trying to get in manufacture. So when that happens, you will see some activity, which is good to see that many more things, even if it is not getting produced, it'll get assembled in India, and that will create its own investment and jobs. But you also have to worry about whether it is going to be inflationary, right? Is importing way cheaper than manufacturing in India, and that cost trade-off the government will always have to do. But these are all attempts to revive and reindustrialize and get manufacturing back into key segments of where we are dependent a lot on imports, and we'll see how that plays out. We also see some short-term worries on the horizon, monsoon especially. The El Nino effect seems to be taking place now, although we got reasonably good rains in June and in July. But from mid-August, we are from the last week and into now, I think we're seeing some slowdown where El Nino seems to be catching up, and we are seeing lesser rainfall in many parts of the country. If it continues in September as well, which is what the private Met weather forecaster had mentioned, that they expect even lesser rains in going in September, then that could be a problem, both in terms of inflation and in terms of politics. Like we've been talking about the fact that 3 or 4 major state elections are coming through, and then of course there's a general election coming in next April and May, and inflation can become a big issue, and that's why you're already seeing uh, you know the government kind of trying to respond to tomato prices and onion prices and wheat prices by releasing stock. They also banned rice exports, which was again a sudden shock decision, but it is from a view to keep food inflation lower, and also with a view of all the politics and the elections that are coming up. So we will have to keep watching that in terms of whether the food inflation problem that we are seeing currently, and it showed up in these consumer price inflation CPI number that came out for the month of July at about 7.5%, driven largely by vegetable prices. But we have to see whether that doesn't become generalized and gets passed into other food prices and then into other services inflation. So we'll have to be watchful. Many were expecting the RBI to kind of cut rates sometime end of this year or next year. Some economists had that view. We never supported it. We thought the RBI will keep rates steady. They might not need to hike it, but they'll keep rates steady. And I don't think that's changing. We will see interest rates remaining reasonably at average. India repo rate is at 6.5%. Bond yields are between 7 and 7.5%. And I think that's where we see rates struggling. Even if the US world, if the US enters into a major recession, then maybe yes. But we don't see that probability as well. Even US is seeing a fairly strong industrial recovery, right, through different acts and Jobs Acts and Chips Act and the Inflation Reduction Act. There is a lot of activity going into the US, so we don't see any major fall in economic activity, which means you should assume that inflation, if it goes above, then RBI might have to actually react to it. But otherwise, we see interest rates in India remaining fairly constant, fairly flat for a long period of time, which means your deposit rates and your lending rates might inch up a bit, but not by all that much. This is very average rate cycle for India. On the currency front, we've seen the rupee depreciate a bit against the dollar, against the pound, against the euro. But I think what we've seen for the last maybe 6 to 8 months is that INR will still remain in a fairly tight range. I think the RBI is managing the INR on both sides. Given that oil prices are also not very high, we should be able to manage the current account deficit, and the RBI can ensure that they basically manage the rupee in a reasonably tight band. So we don't see any major sharp depreciation or appreciation in the Indian rupee in the near term. So thank you very much, and I'll speak to you next month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.